Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures falling this morning after the trade war continues to escalate. Stocks closing lower for a fourth day amid trade-driven volatility, with the S&P 500 now nearing a bear market, down 19% from its recent record high. Meantime, Treasury's tumbling as the trade war sparked fears about the haven status of the U.S. government's debts. Traders also attributing the bond market moves to dislocations in a popular hedge fund trade and speculation of foreign selling, leading to the recent spike in bond yields.
Plus, China is retaliating against the U.S. as President Trump's reciprocal tariffs went into effect. China said it would raise the tariff on U.S. goods to 84% from 34% effective tomorrow. The moves follow Trump's latest levies that went into force, taking the cumulative rate announced this year on China to a total of 104%. Meanwhile, President Trump said the U.S. was planning to announce a major tariff on pharmaceuticals soon, sending shares of pharma companies lower.
And Delta scrapping its full-year financial guidance as the trade wars creates uncertainty for the airline industry. The company announcing it will update its outlook later in the year as visibility improves. Meantime, Walmart maintaining its sales forecast for the year despite tariff pressure. The announcement suggests the world's largest retailer is in a good position to navigate a historic period of uncertainty. The retailer also keeping its outlook for operating income for the year, but widening the range for the current quarter because of several factors, including tariffs.
U.S. stock futures falling this morning as President Trump's reciprocal tariffs take effect. The latest drop sending the S&P 500 within 1% of a bear market. But some strategists are saying the S&P 500's drop below 5,000 means it's time to buy. So what's next for the stock market? Joining us now with their take, we've got Michael Kantrowitz, who is the Piper Sandler Chief Investment Strategist. Michael, good to have you here with us this morning. So is the drop below 5,000 a buy signal?
Not necessarily. I guess I'm more catalyst driven than historically analog driven. I think it depends on investors' time horizon. Of course, a lot of stocks are down a lot more than the popular averages. So for those investors that are longer term focused, perhaps you can start to nibble in on some names that you want to own for the long term. Our clients are institutional investors that have to be largely invested most of the time. And so, we ultimately think the catalyst needs to be a change in the tone of rhetoric, and that a lot of historical analogs may not be as useful today because of this really unprecedented situation.
And talk to me about the retaliation we're hearing from China, that 84% tariff on U.S. goods. At what point, in your view, could the market just get fatigued of the constant ratcheting up of these tariffs? Or do you think that there's still more pain to come as we get these headlines?
It's certainly been a lot of shock and awe in the last week and a half, really since Liberation Day. And I think, we've certainly seen expectations of Trump's policy agenda come more in line with what is the current reality, whereas I think most investors were not believing that Trump would do what he ended up doing or anything near what he ended up doing. So that potentially could lead to a little less of a negative reaction. But if things continue to escalate and the duration of this persists, then we start to see the data get worse, and that could lead to people focusing on a more ominous outlook for the economy.
Michael, you mentioned you're catalyst driven. To what extent is this earnings season a catalyst either to the upside or the downside, as we're starting to get some of the kind of early thematic common denominators that could be cited among some of the most major and household name companies, and that word is uncertainty?
Yeah, well, I think it's interesting. Today we heard from both Delta Airlines and Walmart, two companies that really provided a huge negative shock earlier this year when they reported their earnings. And today, Delta Airlines, I think that stock is flat or even up a little bit, despite the market being down. They pulled their guidance, which I think we're going to see a lot of in this earnings season, because the reality is just that everything is so policy path dependent, and companies aren't going to really be able to provide high quality, high conviction guidance. Walmart maintained their guidance for the full year and for next year. So I'm not so sure we're going to learn a whole lot, but certainly expectations have come down a great deal with the market. And so I'm not so sure. I don't think earnings season will actually be a big negative catalyst. I think it'll give investors some hard data to wrap their hands around, some understanding perhaps of how business has been in the last couple of weeks. I think that'll be a question that investors are asking, because what happened in the first quarter at this point is really old news. But I think we'll see more corporate uncertainty rather than corporate bearishness. So it could be something that actually is more of a stabilizing factor rather than a big negative.
To what extent are valuations coming in a bit? And I'm hearing this question from a couple of retail investors, that they're nibbling where the valuation problem has gotten less significant. Is that something that you're hearing from substantial market participants, that valuations coming in might be a positive catalyst?
Yeah, certainly, we came into the year with extremely high valuations, and even if the consensus earnings numbers for the market, which really haven't come down all that much for the full year, are indeed what ended up happening. The market's multiple is still fairly high compared to history, and the issue with valuation is that if the earnings outlook is uncertain, and it is literally getting uncertain by the day, more uncertain by the day, then you don't really you can't really trust that valuation, because you don't know if the earnings are to come in. You may be looking at a stock you think is trading at a 15 multiple because you're assuming the earnings expectations are solid, and you end up realizing down the road that the earnings missed by 20-30%, and the stock was actually trading at 20 times back then. So that's the issue for the overall market. So yeah. I don't know if valuation. I don't think valuation is going to be a stabilizing factor for the market because of that uncertainty around earnings.
So then what are market participants hoping for? What is the big, great hope that you're hearing from folks? Because I can't find anyone, none of my sources have said that they are positively viewing these tariffs at this point. They just want them to go away. So what is the hope from participants that you're speaking with?
Yeah, so I've been trying to focus on what could go right, because I think, like you said, the negative outlook and the bearish story is really easy to make, particularly if these tariffs all stick. And so it's unlike, again, any period in history, in that usually markets go down because there's an oil shock or an interest rate shock or an inflation shock or an employment shock, a recession. And so you have data to look at. You can kind of, we know how the business cycle works more or less. We know how the Fed will react in this period, in this backdrop. It's really the policy that's driving everything thus far. And not so much the economic data. We really haven't seen much bad economic data, at least with respect to hard data, because all this has happened so quickly. So it makes it, people want to see better, some kind of wavering, I guess, or some deals being structured. But, I think the expectations that the market's just going to bottom and shoot back up, and that Trump's going to, wipe out all these tariffs is very unlikely. And I think we're going to be dealing with quite a bit a higher level of uncertainty for some time. Maybe we get some news on some deals or some negotiations start with China, but maybe they break down in a month, and so or maybe President Trump gets wants to go gets upset by China and says, okay, the tariffs are back on, and so this is all possible. And I think that's going to maintain a high level of uncertainty in markets that are going to be quite choppy and very driven by the news. The other potential near-term catalyst could be that the courts put a stay on some of these tariffs. That was, or there's some delay in them. But again, that's a short-term Band-Aid, not a long-term bull case necessarily.
All right, Michael, we got to leave it there. Thank you so much for joining us. Appreciate it.
Okay, bye-bye.
President Trump's latest wave of tariffs is now in effect. Imports from roughly 60 trade partners are subject to higher duties in the U.S. The latest announcement now bringing China's total tariff rate to 104%. On Tuesday, President Trump praised the effectiveness of his levies in bringing nations to the negotiating table.
We're doing very well in making, I call them tailored deals, not off the rack. These are tailored, highly tailored deals. We've had great consideration. We've had talks with many countries, over 70. They all want to come in.
Heather Boucher, former member of the White House Council of Economic Advisors under President Biden, joining us now. Heather, great to speak with you. I got to start on the news from this morning, which is China retaliating with that additional 84% levy on U.S. imports. How far could this go? How high could these levies potentially get on both sides?
Well, at this point, we're in what we call a trade war. And, certainly the president has indicated that he's not willing to back down. And the Chinese have now come to the table and said, we need you to respect us. And they also are saying that they are unwilling to back down. I think what is disconcerting is how prepared they seem to be. They knew when President Trump was elected that he was going to be focused on trade and that he, had called himself tariff man. So they seem prepared for this moment. And, if we care about, coming back to a sane set of economic policies that will deliver for the American middle class, this war this morning that we're seeing in tariffs is certainly not a good thing.
I mean, Heather, we can't kind of mince words here. These are some of the highest tariffs that we might see in world history. And so with that in mind, how unprecedented of a state are we in now, and how much more difficult does that make negotiations going forward from here to bring them down from those levels?
Well, I mean, this is the thing. We have spent decades building up a global economy with highly integrated supply chains. And China has been a key part of those supply chains. And, here we are with this imposition of tariffs in a very, the way that the president has done this, since he's come into office has been very chaotic, on again, off again. Now he seems to have, he's made these big steps. He said one day I'm not negotiating. Then 2 days later, oh, I am negotiating. So I think both this uncertainty, where is the president going with this? What is his end game? And is the goal to make sure that the United States has vibrant manufacturing sectors in producing things that matter, that we can be competitive in, that are going to help create good middle class jobs? Or is it retaliation? Is it, something else? I think we're all wondering that. And that is, I think, what makes both the level of these tariffs so unprecedented. But I think, as everyone's talking about the off ramp for how we're going to get back to a sane economic policy, also seems very unclear at this point. I just keep thinking this is a president right now who does not have the concept of a plan for what he's going to do to improve the domestic economy. That is what he was elected to do. It's what many of his voters want. It's what the American people need. And yet that it does not appear to be, there does not appear to be a plan and does not appear to be his priority.
And Heather, investors are grasping for anything that may be able to put pressure on the president's tariff agenda here. I spoke with Senator Elizabeth Warren about this, and here's what she said on that.
Congress has power, and that Congress can roll these tariffs back and steady this economy out. But it's going to take Republican support to make that happen. The laws are in place. We just need to vote to make that happen.
Heather, what's the most likely off-ramp to the severity of these tariffs in your view? Some kind of negotiations unfolding slowly over time, or actual feasible congressional pushback?
Well, here's the thing. What President Trump has done is shocked the global economy and particularly shocked the U.S. economy. And so what, I think many of us thought, if markets dropped, he might change his tune. He certainly has not. He, has said he doesn't care if people's 401ks go down. He doesn't care what's happening in the markets. He had said we might need to have a recession. He said he doesn't care if things get more costly for American consumers. And, on the other side of his administration, he has, allowed Elon Musk to make all these these decisions that mean that the kind of jobs we will create or the supports that firms need to make these investments, to create this new world that he says he wants to see, he's actually tearing away all the foundations for them to do that. And of course, he's gutted the Department of Labor and made it harder to enforce labor law, which will, of course, not lead to better quality jobs now and into the future. So I think, what is going to contain him, what the next steps are. You heard the president just say himself, he's got all these countries calling him, and now he's saying, it's going to take us a lot of time to figure out how to make these deals. Well, if they had a plan, they would have known that. It seems like his own advisors are not prepared for this moment. So, and yet the global economy, markets are responding very, very quickly. And the pain that could be felt for American workers and American communities in the short term could be very dire. So I do hope that action is taken quickly, but I think by the minute we are losing hope.
Heather, thanks so much for taking the time here this morning. We're going to continue to track all of the developments, as we know you will as well. Thank you.
Thank you.
Coming up on Morning Brief, we count you down to the opening bell on Wall Street, plus a check-in on Pharma stocks as Trump says those are the next on the trade docket. And a look at automakers as President Trump's reciprocal tariffs go into effect. We'll discuss that and much more on Morning Brief. Delta Airlines withdrawing its full-year guidance due to economic uncertainty around global trade. The company is still expecting a profit in 2025, despite revenue growth stalling in the first quarter. I spoke to Delta CEO Ed Bastian about his outlook. Take a listen.
I'd say the economy structurally is pretty sound. It's just one set of actions that's caused this level of alarm. So hopefully we'll have resolution in the coming months here, so that we can get back to our growth trajectory. But I think until there's a little better clarity on the horizon, we're going to have to go a bit into defensive mode and at least take out any of the cost of growth in our business to the best we can.
Joining us now, we've got George Ferguson, who's the Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Industry Analyst. George, good to have you here with us. Just want to get your biggest takeaways from the report, plus the additive of the set of actions that is very clearly tariffs that many CEOs are going to have to acknowledge in some facet or another this earnings season.
Yeah, so I guess my biggest takeaway was it wasn't as bad as we had expected, Delta's results. Obviously, they reset them, right during the J.P. Morgan conference, so we're working off lower expectations. But we still saw some positive yields in the domestic market. The Atlantic market was still pretty strong. So my sense is that Delta's looking a bit forward, like you heard Ed Bastian just say, and incorporating these results are clearly not the recent tariff-related disturbances in the marketplace. That's going to affect demand for sure. And I'm sure, Ed obviously is seeing fares come in or demand real time, which we aren't. But 1Q, again, wasn't as bad as we would expect. 2Q looks like we're going to have to bring some numbers down. The market's consensus seems a bit high. But like Ed said, I guess he thinks it's still structurally sound if the turmoil can be eliminated.
But George, what's he going to say? Yeah, I'm really worried about the future of the company. How real do you think it is that there are enough consumers who are going to have to continue air travel, of course, in that being enough of a bottom on any consumer and economic slowdown that we might see for not just Delta, but the other airlines?
Well, I mean, so I do think if markets keep trending this direction, premium travel, which was a strong support for Delta, isn't going to hold up, right? Mm-hmm. I think that one of the things you're going to see, transatlantic has been really strong for a lot of these airlines, a lot of the full service, Delta, American, United. Transatlantic travel is something you book with a lot longer lead time. So folks are just sort of waking up to the idea that their net worth is a bunch lower than it had been a month ago. I think as you get a month or two out, people are not going to be booking transatlantic travel. That's going to hurt a lot. So I think Ed is starting to take actions based on the trajectory we're on. And so, yeah, he's not going to set off an alarm right away, but he's obviously concerned, and that's why he's cutting capacity in the second half. And it'll hurt the other airlines in the market as well, right? I think Delta is one of the better performers on revenue, and so my expectations is we'll see worse results from the rest of the U.S. airline group because their revenues just won't hold up. They won't have the premium. They won't have the loyalty programs to support them as well.
You know, that's a great point, George, in that for the rest of the airlines industry, as they start to come out with their reports, this is perhaps a precursor to what we can expect to hear from them, but they're not in as good a premium position as Delta has been and continues to maintain. So what does that kind of hold for their end of the consumer cohort or groups that they continue to go after?
Yeah, so I think their consumers are going to be hurt worse, right? I think their consumers have been feeling the pain of inflation. They won't like the uncertainty, and again, they're not going to have some of those really high premium travelers that can just drive through an economy like this and continue to consume like they always had. So it will be a lot more difficult. But again, the challenge for the Delta clientele is they're probably, really. Their demand is really supported by the market, by the stock market and confidence. And so I think Delta could see a lot further slippage than some of those carriers probably already have seen.
All right, George, really great overview as always. Thank you for making time for us. Appreciate it.
Sure.
Well, drug makers are falling today after President Trump announced tariffs on pharmaceutical imports could be coming shortly. Yahoo Finance's Anjali Kemlani is here now with more on the potential levies. Anjali, what can you tell us?
That's right, Manny. We heard from President Trump last night at the National Republican Congressional Committee dinner saying, quote, "We're going to be announcing very shortly a major tariff on pharmaceuticals. And when they hear that, they will leave China, they will leave other places because most of their product is sold here." He's right about that last part. The U.S. market is a large one for pharmaceuticals. But there are questions about which companies will be hit more than others. You can see on your screen some of the stocks that are getting hit, some of the ones that are native to the U.S. and do have manufacturing already set up in the U.S. We've heard already some of these commit to even further expansion, including Johnson & Johnson with a $55 billion commitment, Eli Lilly with 27, and Merck with about $8 billion in recent months. In anticipation of this announcement and of the tariffs, we know that they were exempt from the initial round of tariffs that were hitting countries specifically. But we do know that also those that are based in the EU, for example, or in Europe in general, have a little bit more concern about the impact of the tariffs. Names like AstraZeneca, GSK, as well as Sanofi are among those that are headquartered overseas, but some of them do have some manufacturing here. Also questions about the general supply chain of pharma, which includes, active ingredients or sort of base formula ingredients from China and other countries versus the fill and finish process, which is the end process that takes place here in the United States. All of it a very complex question for these companies. There is also a trade group in Europe that has already warned the EU that they will see a shift to the US and an outflow of capital if it does not strengthen its own rules and regulations in the country to kind of encourage companies to stay there. So a lot going on right now. We don't know the details of any potential tariffs. So we just have to wait and see what those numbers look like in order to know the true impact.
Anjali, thanks so much. Appreciate it. Automaker stocks are extending losses as President Trump's sweeping new tariffs take effect. This after the U.S. implemented a 25% duty on all cars imported into the country. Yahoo Finance's Pras Subramanian is here now with a closer look at the impact here. Pras, what do we know so far?
We're seeing European automakers falling today. This has been a continued decline since these tariffs have been sort of hinted at and now fully in effect for 25% on autos. We're not going to include any reciprocal tariffs. It's just a pure auto tariff, right? So that's still not good, but not great. We're seeing that a lot of these European automakers like BMW, Mercedes, Volkswagen even are levered to the U.S. because of their exposure there. But they also have factories here too, so they can try to alleviate that. I was surprised to see that. It's funny enough that the U.S. automakers have the most exposure to imports here because they import a lot of cars from Mexico and Canada, right? And they sell mostly in the U.S. They don't sell elsewhere, so that affects them as well. So just a massive amount of costs layered on here on a cost-sensitive business. And finally, I saw a report today about how the tariffs on U.S. goods in China actually does affect some automakers here. The GM has a export business with a lot of their SUVs going to China recently. They're all built here. Also, Ford imports a lot of Lincolns there to China, which is a big deal. And also BMW, because they have a big plant in South Carolina where they make all their SUVs. Those also go to China, although they've been localizing some of that production. Still, a decent amount, 20, 30,000 vehicles goes to China. That's going to be hit with these massive tariffs there. So it's not just a problem for European automakers. It's also U.S. automakers and also even some that export from the U.S., believe it or not.
And it's clear that given the amount of exposure you just laid out, prices are going to go up. Have you heard reports of consumers panic buying cars ahead of any tariff impact?
So we saw sales in Q1 pretty strong across the board for most automakers, and in particular March was a very strong month for automakers, but that kind of hints at the fact that people were getting ahead of the tariff curve. And we were at a New Jersey dealership about a week and a half ago, and that floor was humming at the end of March, was humming. A lot of people, they're coming in wanting to get...
March is usually a down month?
No. I mean, typically, it was a normal day, a normal end of the month usually is busy, but the dealers were telling me that this is more activity than we're used to, on top of the fact that, seasonality. But it's really kind of concerning that that's happening right now. And I'm also seeing websites, I don't know if you guys have seen various automotive websites. Oh, these are our tariff-free cars. They're listing their cars that they claim are tariff-free. So it's already happening.
All right, Praz, thank you so much for breaking it down for us. Really appreciate it. As always, we're going to have all your markets action ahead here at Yahoo Finance. Stick around. Morning Brief next.
There you're taking a look at the opening bells. We got two of them. At the NASDAQ, we got the first one. That is Chamber Magic. Well, technically they're at the same time, so neither is first nor second, but 9:30 a.m. Eastern time, which means go ahead and press that button. And they felt so good, they pressed it twice at the New York Stock Exchange, where Mistras is ringing the opening bell at the NYSE. All right, taking a look at the major averages as we begin today's trading session. The Dow Jones Industrial Average opens up lower to the downside by about 0.8%. The S&P 500, you're seeing that open up lower by about 0.5%. The NASDAQ Composite, though, that's seeing a touch of green, a spot of green to begin today's activity. It's up by about 0.2% here. So this all as we're considering some of the tariff activity that has both gone into effect and that is continuing to be ratcheted higher as well between the U.S. and China. We've got some of those developments and continued conversations as well throughout the rest of today's programming. But taking a look at some of the market activity in terms of just a little line chart here that we've been able to put together for you folks at home. Taking a look at the past 3 days activity for the NASDAQ Composite, we're still net lower over that period of time, over those past three sessions by about 2%. Also taking a look at the S&P 500, you're taking a look at declines of about 2.3% there over the past three sessions. Past three sessions for the Dow Jones Industrial Average, about 2.7% in the red. Want to take a look at some of the sector activity out of the gate here this morning. We are mixed, but clearly there are more laggards than gainers. Right now, technology leading the pack. That's up, catching a bid to the tune of about 0.4%. So some fractional moves higher for consumer discretionary and for technology. However, pulling up the caboose right now, you've got 1.7% decline for healthcare. That is as some of the new tariffs that could be on the docket are targeting some of those pharmaceutical companies. And then just lastly, let's ride out with a quick look at the NASDAQ 100 here. I'll put this on an equal view just so we could see what the split looks like here. It looks like more green than red. Ultimately, though, pulling up the rear, we've got AstraZeneca, of course, this continuing the theme of some of the largest pharmaceutical companies getting hit the hardest here. Regeneron, Gilead, also pulling up the caboose there. Leading the pack, though, here today for the NASDAQ 100, Strategy. MicroStrategy formerly, but you're seeing that up by about 4.2% here on the day. There we go. I knew that chart would pull up for me if I just kept trying. It's up by about 4.2%. All right, with all that effort in mind and in the rear view mirror, let's toss things on over to Yahoo Finance's Jared Blickery for a deeper dive.
Thank you, Brad. Stocks are looking for a fifth straight down day, but not necessarily the NASDAQ right now. And the S&P 500, guess what? S&P 500 just turned positive. I do want to show the year to date, and there we go. And you can see we just kind of fell off a cliff a few days ago, trying to find our footing. As I was saying yesterday, it's a battle between the bulls and the bears, and we might be in search of that momentum low. It might be in place right now, but we're feeling things out. And all these additional tariffs, that's brand new news that has to get digested. And so that can definitely tip the scales in favor of the bears once again. So we'll have to see how this plays out. It's playing out in volatility in a big way. The VIX is now holding above 52.38. If I put some candlesticks on here, you can see we've been above this level basically for 3 days. And that's not the best sign, because that means institutions are still trying to figure out what they're going to do about these, about their trades here, and they're looking for protection and hedges, and those are expensive right now. So that's a dynamic playing out there. Then we have the 10-year yield. This is again a year-to-date chart. It has surged now off of these lows down here from about 3.9% all the way up to 4.4%. That is 50 basis points in 4 days, or 3 days actually. That is just a huge amount, and we'll have to see how this one plays out. But bond market volatility generally not good for equities. On that note, let's check out what the equity sectors are doing. As Brad just mentioned, tech now up over 1%. It is the leader today. In the down position is real estate. That's down 2.5%. And we went into healthcare a little bit. Biotech really taking it on the chin as well. Here's a year to date, though. I just want, or actually not year to date. Let me point out, since the 2/19, that's February 19th top, tech is by far and away the worst performing sector. That is down 23%. So let's get back to what's happening today in the NASDAQ 100. Brad just went through this as well. I'm not going to linger. NVIDIA had been leading the Mag 7. It looks like Tesla is now doing that work. But overall, pretty constructive day for some of the bigger stocks here that have been really an albatross on the market's neck. Let's get to now Chinese stocks, because even with all these additional tariffs, we are seeing a lot of green in the Chinese market. Alibaba is up 2%, JD up 2.5%, Xpeng up as well. And you got to be asking yourself, has all of this been priced in already? Is this just a knee-jerk reaction? Are markets and investors anesthetized to all these new changes? Well, let's watch what happens into the close today and over the next few days for that answer. Then over in futures, gold is experiencing its greatest jump. It is soaring the most since April of 2020. And here is the yellow metal up 3.33% right now at the highs of the day. That's 3,089. Not quite record highs, because it did stumble a bit when we had that market meltdown over the last few days, going back to last week. But it is quickly reclaiming that lost territory. And so this is a market that you definitely want to keep an eye on. And I'm going to close with Bitcoin, as I like to do. It's under a bit of pressure here, but I would note it is holding 75,000. In fact, it's at 77,200 right now. I have support all the way down to 70.72, and so anything within that range is not disaster, but it would be nice if Bitcoin could just kind of flush out some of those weak longs and rocket higher and lead the risk markets to some of their former glory here. Just my personal wish, and we'll have to see that plays out, Maddie.
All right, Jared, thank you so much. It's time now for today's strategy session. The bond market's safe haven status coming into question. 30-year yields surging 60 basis points from last week's low. As the long end of the yield curve continues to rise, what is the signal that bond investors are telling us? Here with more, we got George Borey. He's the chief investment strategist for fixed income at Allspring Global Investments. George, great to speak with you. Therapists might say that the bond market is putting forward an emotional call right now. What does the bond market want us to understand? What's it signaling?
Yeah, well, I think, good morning, and thanks for having me on the show. Really appreciate it. I mean, the bond market, similar to the equity market, is in the process of digesting the changes in tariffs. And there's a combination of, initially there was just fears of growth and growth slowdown, and we saw bond yields rally, bond prices go up, yields down. But since then, we've had some thoughts about potential inflationary impulses likely to come through over the next several months. And importantly, the Treasury needs to finance itself with considerable amounts of debt issuance, which leads the market to some levels of vulnerability. Whenever we have an auction week like we're seeing now, we tend to see bond yields sell off, and that's in anticipation of new issuance. And so there's an element of that sort of working its way through the system. Plus, bond investors want a bigger term premium. Now, that's a fancy way of saying they want to earn a little bit more out at the long end, simply because there is this big question mark as to how tariffs are going to work their way through the system. They may ultimately be inflationary. And so bond investors need some extra premium to sort of offset that. So it's a combination of, sort of market recalibration, some very rational sort of fears, if you will, about inflation for bond investors. And then there's this technical uncertainty as the Treasury does need to issue considerable amounts of debt, not just today, but in the coming weeks and months.
So what side of duration is safest to play when you have an unclear trade war that's continuing to ratchet higher?
That's a very good point. We think that, holding treasuries and having some duration in your portfolio is really important. Bonds are the steady cash flows that come from bonds are very powerful. And so, what we're telling investors is have some duration in your portfolio. In and around the 5-year part of the curve is fairly attractive, but we can go out a little bit further. And in that environment, sort of that bonds provide certainty in an uncertain world. They're contracts. And so you want that consistent cash flow coming to you as you move through time. Now, the yield curve itself is steepening pretty dramatically. As I just mentioned, the very long end of the curve is pricing in this uncertainty as it relates to inflation. And at some point that will, sort of reflect, it will be fully priced. It's hard to say that that's fully priced today. So we're still cautious on the very long end of the curve. But that sort of intermediate part of the curve in and around the 5-year plus or minus a couple of years, makes a lot of sense to us because you do benefit from downside protection. If the economy does slide into a recession, you would expect those bond yields to be fairly well anchored. They're also connected to the Fed. And while the Fed has said they want to stay on hold for the time being, to the extent you get economic weakness, the Fed would likely cut rates, and that would bring those yields down and help boost those prices. So there are opportunities on the yield curve to sort of position yourself to benefit in this kind of environment.
Since you bring up the Fed, I want to talk to you about the probability of a rate cut. Right now, we're looking at about a 55% probability of a rate cut on May 7th. That's obviously been coming down. Is that the bond market and investors indicating to us that the Fed cannot control what's happening in this market, that even if they did cut, it's not going to matter? It's not going to put the tariff genie back in the bottle?
I think that's a great point. The Fed is in more reactionary mode rather than proactionary mode. In the past, when we have sort of a shock to the system, the Fed usually is in a place to be able to just simply try and reflate the economy in the hopes of offsetting, whatever shock has kind of hit the economy. This is very different. The federal government, is changing the tariff policy as it relates to trade. And so the Federal Reserve is not really in a position to sort of simply push back against that. So the Fed's job is really to sort of keep an orderly financial market and then respond to the economic consequences that result from different policy changes. And we don't know exactly how this will filter through the economy. And Fed Chairman Powell mentioned that at the end of last week. The probability of a recession's gone up and the possibility of inflation has gone up, but it hasn't happened yet. So they're in reaction mode. They're not in proactive mode. And I think that's a very important distinction in prior, sort of shocks when we see major dramatic spikes in volatility.
Yeah, that data dependency will have them in reaction mode for quite some time here, George, from what we can gather upon what they've continued to say and signal to the street. George, thanks so much for taking the time here with us this morning.
Thank you.
Coming up, everyone, China to raise tariffs on the U.S. to 84%. How one expert believes that the tit-for-tat trade war will play out. Treasury Secretary Scott Bessent calling China's retaliatory tariffs on the U.S. unfortunate this morning. That's as China levies a 84% tariff on the U.S., set to take effect April 10th in response to President Trump's 104% total import tax. Joining us now from Washington with the latest commentary from the Treasury on trade policy, we've got Yahoo Finance's own Jennifer Schonberger. Good to see you, Jennifer. What do we know?
Good morning, Brad. Great to see you as well. Treasury Secretary Scott Bessent, speaking in Washington this morning, says the level on reciprocal tariffs, which kicked in this morning, serve as a ceiling for countries who do not retaliate. He reiterated that 70 countries have lined up to talk to the United States and joked that he does not have any plans to go anywhere for Easter. He says he believes that the U.S. can forge deals with U.S. military allies and that perhaps together as a group could approach China to try to cut a deal. The secretary said he thought he had heard from Spain that that country was looking to potentially realign with China. He said that that would be cutting off their own throat. Now, separately, speaking in an interview with Fox Business this morning, the Treasury Secretary did comment on the unwinding and massive sell-off of U.S. Treasuries, saying that it was just normal deleveraging, not anything systemic, and certainly not China selling U.S. Treasuries. He also warned about China devaluing its currency. He says if the world's second largest economy continues to do that, then that means tariffs will need to be ratcheted up higher. He also did not rule out delisting Chinese companies from U.S. stock exchanges. Now back to the Secretary's comments at the American Bankers Association this morning. He was asked about the state of the economy and said, quote, "I think we're in pretty good shape," though he warned that not extending the tax cuts and passing a tax bill would result in a recession. He also noted this morning that he is proposing a litany of new ideas to try to tailor regulations for small and community banks to promote lending and economic growth in this economy. Back to you.
Jennifer, thank you so much. Amid the growing trade war here, you can see stocks flipping around this morning between negative and positive. Your tech-heavy NASDAQ moving to the upside here. This coming as China increases its retaliation against President Trump's 104% tariff. Beijing announcing this morning it will raise tariffs on imports from the U.S. to 84%. That's up from that 34% announced a week ago. And the 84% set to go into effect on April 10th. Here with more on how the trade war could play out, we've got Zoe Leo. She is the Council on Foreign Relations fellow. Zoe, great to have you on here. The goal of this policy from the Trump administration is to hurt China. Could it hurt the U.S. first? Oh, Zoe, we're having a bit of trouble hearing you. We might have to come back to you. Can you hear me? Perfect. I can hear you.
Yes, I can.
Go ahead.
Yeah, thank you, Allison, for having me. First and foremost, the United States and China remain to be very much interconnected. Rising tariffs on imported Chinese goods ultimately is going to hurt U.S. consumers as well as U.S. manufacturing activities because a lot of Chinese imported parts are inputs to manufacturing plants here in the United States. And for folks who intend to remodeling their kitchens or their homes, probably we are going to anticipate a price increase, not just in terms of home appliances, but also drywalls and a host lots of other stuff.
And so, as we're thinking through what necessarily needs to take place and what will be experienced by a consumer in both of these regions, what are the net impacts for what consumption may look like and how that'll be ultimately rattled in the near term?
Brad, that is a very important, a great point in terms of consumption. I would say that Chinese exports or demand for imported Chinese goods here in the United States are very much tied to the broader macroeconomic situation in the United States, especially household income. If household income can catch up, or even to the extent that it can offset price increases caused by tariff increase, perhaps the shock on imported Chinese goods in terms of consumer demand here in the United States may be slightly offset. But that is completely unsure, uncertain yet. And then on the Chinese side, the Chinese government has been promoting consumption plan or promoting expanding domestic demand at a household level for quite some time. But they become very sincere, seems to have concrete plan as of the end of last year. In December, the government, the party's central finance conference talked a lot about concrete policies to boost domestic consumption. And this, the same tone or the same mood was also happening during the National People's Congress as well as the China Development Forum. Rather than focusing on the new productive forces, focusing on technological development, like last year, this time the focus is on concrete plans to promote domestic consumption. And I think the policymakers understand that China's export face rising protectionism, not just from the United States, but developing countries as well.
Zoe, really great context and insights there. Thanks so much for taking the time here with us today. Zoe Liu.
Thank you.
When we return, what Walmart CEO has to say about the Trump tariff action. We'll bring you the latest when we return.
I want you to know how confident I remain in our company. I've seen us navigate times like the period after 9/11, the global financial crisis, the pandemic, and more recently, high inflation. While in the short term, we're not immune to some of the effects, we are positioned to play offense. Nothing about the current environment impacts our confidence in our business or our strategy. The changes we're making add even more strength and flexibility for our future.
That was Walmart CEO Doug McMillon referencing the current environment with President Trump's tariff policies rocking markets over the last 4 trading days. McMillon making the comments at a meeting with analysts and media to discuss longer-term initiatives. Ahead of the meeting, Walmart announced it's scraping its quarterly operating income forecast and amid uncertainty around tariffs. Here to discuss, we've got Yahoo Finance senior reporter Brooke DePalma.
Good morning. Well, shares of Walmart actually turning to the upside now after a dip in pre-market this morning, largely because Walmart is here laying out their game plan here to address Trump's tariffs. In addition to that, they also said that their e-commerce business is set to achieve profitability on an annual basis this year. Q1 profitability for their U.S. e-commerce business expected to turn profitable as soon as Q1. Now, CFO John David Rainey did give some color on that weaker consumer sentiment that we're seeing right now. He said the uncertainty and decline in consumer sentiment has led to a little more sales volatility week to week and frankly day to day. He said in particular category mix has been less favorable than what we had expected at the beginning of the quarter. He also went on to say that general merchandise sales were softer earlier in the quarter, but they improved as the quarter had progressed. He did say that they see opportunities to accelerate share gains and are more maintaining flexibility to invest in prices as tariffs move forward. Now, they did reiterate that their sales forecast is still expected to come in between 3 to 4%. They do expect on an annual basis of sales growth of 4%, and they expect their operating profit to increase ahead of their sales. That's optimistic for investors here. Now, one thing that I do want to weigh in on is these 3 key points that Walmart loves to say. They love to say that they have their deeper relationship with suppliers because of 3 main points: their omnichannel accessibility, their price leadership, and assortment of membership programs. We know that Walmart has been investing in these alternate profit streams, one of them being that Walmart Plus business. And so certainly that gives the opportunity for them to get more data from their customers, understand where their customers are at, and then ultimately bring that back to their suppliers and really negotiate, especially in this sort of environment.
Yeah, I think that a really great kind of rubric for other CEOs to potentially follow just in terms of language around these tariffs is you can say you're actually going to use this as an opportunity to increase market share. That is something that investors are, as we can see in the share price today, going to be happy to hear. Brooke, thank you so much. Really appreciate it. We're going to do a final check on the major averages here. You can see we're flipping back into the green just about a half hour into your trading day. Your S&P up about 0.8%. Tech taking up the majority of these gains here. Your tech-heavy NASDAQ is up about 1.6%. Interesting to see whether or not we will still see a day of midday green and in red. That will be the key question for markets today. That's going to do it for Morning Brief. Join me in the next hour for more on Catalyst and then Brad for more on wealth. Stick around.